Best tax deferral strategies for high income earners. And you high income earners are my favorite client because you overpay tax. So you start with the problem that we solve the best. So today I want to talk about how corporate structure, your entity structure, is your number one strategy. And you say, well, I'm a high income earner. Well, if you're a sole proprietor, you need to get incorporated. If you are a W-2, you need to get an operating company. Second thing we're going to talk about is the C Corp and how the C Corp can absolutely defer taxes as a strategy to work on an offset tax year. And then the third thing is how your IRA, your self-directed IRA, your Roth IRA, your 401k Roth, all of that can be a huge piece of a tax deferred strategy for you high income earners. What does it actually mean to do tax deferral? Because so many of you that are here on the bathroom wall, I call the internet the bathroom wall because you can talk about anything, is most of you think tax preparation, meaning file a tax return, is enough in all of this strategy. So let's talk about what tax deferral means. It does not mean tax avoidance. Tax deferral means you're going to earn the money now and pay the tax later. Ideally, never. The way the wealthy do it, which is how we do it through entities. We do it through real assets, meaning alternatives, real estate, gas and oil, like we own the asset, not the stock. And we work with tax strategists that actually knows the tax code. There's between 81 and 83,000 pages of tax code in the United States country. When I talk to Canadians, Mexicans, people from Spain, all over the world, Australians, a lot of them actually activate our tax teams, who are a lot of them cross-border, cross-continent, and they will activate a company inside the United States. It's an absolute strategy for the higher net worth and you higher income earners. So the reason that entity structure is your number one strategy is because of the large scope of the tax code, and there's two ways to make money and get taxed. You're either going to make money as a high income earner as a W-2, a paycheck, taxed immediately, and you get what's left. Or you are going to have a company that makes the money. You could activate all the deductions, then you get taxed on what's left. It's obvious the choice that you want to live in this one. But if you are a high income earner and you have a huge job, a necessary job, a government job, teaching job, firefighter job, policeman, we need you to have those jobs. So then how do you have the same benefit of the offset? You can have a company. It needs to have a legal intent to make money, and it needs to be an operating company. And you say, well, what kind? Well, you got to call our office and let our experts help you. It's a larger question than, oh, should I just go to the Secretary of State and very quickly get an LLC because that's what everybody else on the internet's saying. So the bathroom wall is just that. Anybody can write anything. You want to have a full integrated team. So this isn't just you going to the Secretary of State and then coming back to us, which many of you do, and then you have the wrong entity. So we will use it over time. Don't worry, we're not going to have you take it down or still you spent the money to set it up, but set it up right from the beginning. What is the company that's going to give you the best benefit given all the other money that you make in the household? So if you file jointly, you got issues. If you file yourself, you may have issues. So let a tax professional, a strategist, go through it meticulously and tell you which kind of entity is going to be the best for you. The difference between a C Corp and an LLC, an S Corp, and limited liability partnerships, those three wrap up 12/31, end of the year, like you. So whatever you did up between January and December 31st, that would go through your own personal. It would go through an S Corp, an LLC, and a limited partnership. So then you file tax. The benefit of a C is it can have an off-year filing. It can file in March. It can file in June. It can file in September. So when you have an off year, you have a relationship between the companies. So we teach this management strategy of contractual relationships between companies. So literally they're having a legal relationship, corporate documentation, resolutions. So here's an example. Say you do a lot of rehabs. And you have a variety of LLCs that are doing rehabs on commercial properties, maybe a mobile home park, maybe an RV park, maybe a storage unit. Okay, so if you have those four, there's probably 4 LLCs in your state, depending on your state, because California, New York, Pennsylvania, New Jersey, there's a few of them that gets more complicated. But what you can have is in a C Corp be the management company of it all. So it's the one that buys the supplies. It's the one that actually holds the lines of credit. So it's the money, essentially, call it the hard money lender in the relationship. That's not what we call it legally, but just to give you a sense of it. So now you have money, credit, funding, and an ability to have the C Corp make money, and it helps fund and benefit these other 4 companies for the storage unit, for the RV park. So then that's how you create the management relationship. And then you pay it back and forth legally as the projects go on. So then at the end of the year, if you end up with a big tax burden, you can do a couple things. And I'm going to talk about the 401k and IRAs in a moment, but that is one strategy before the tax year end. If not, then you need a legal relationship with the C Corp, because once 1231 comes in, if you don't have a C Corp, you don't have an off-year strategy. It's too much money being pushed through to a 1231 tax return. Now, if this is confusing to you, you can always go to Ask Loral, AskLoral. Ask a question, make a request. You can also download our tax and entity report. It's down in the show notes below. While you're here, I want you to subscribe to the channel, click the notification button. I want you here 5 days a week. We're here for tax strategies to create tax efficiency for high income earners and people who really want a legacy. That's what this channel is about, and we're going to consistently go after it because so many of you just compromise. If I'm told again, I just don't have time, I have such a busy life, then just keep overpaying taxes. And the problem I have is I want to wake you up because so many of you don't realize that overpaying taxes is a choice. It's an invisible pain that you're just used to. But there are strategies you could put into your life to make your life more efficient. Just think if you kept $10,000 a year for the next 20 years in taxes and not overpaid 10, which some of you, you're coming to me and saying, I paid $114,000 last year. This is just today. I paid $72,000 last year. I paid $18,000. All of that, is that really necessary? Or could you have kept it, more of what you earned, by having a tax strategy? So you have a plan. It's just not a plan. You're just spending money, spending money, spending money. When you spend money inside of a tax strategy, you're spending money with business corporate deductions, not personal expenses. You don't go on vacations, you go on business trips, etc. So one of the biggest moves that you're going to be making during the year is to decide if you're going to fund your IRA. So why self-directing your IRA is so pivotal is on lower income years. If you have a lower income year, then you actually fund towards a Roth. Either way, I believe you always fund your Roth, which means you need to make under $105,000 to do that. So if you don't, you're paying yourself too much. So I do a lot here on this channel. You can go to the playlist and look at how do you quit your job? How do you pay yourself less? I only pay myself $42,000 a year because my companies make money. I don't need to. I, Loral, don't have a lot of bills. I don't have a phone bill. I don't have a car bill. Companies pay for those deductions. I don't. The other big tax strategy for so many of you high income earners is to understand depreciation. Right now with the big beautiful bill, you've got bonus depreciation, you've got R&D credits, you've got cost segregation credits. You have so many strategies that if you actually activated the tax code the way we are going to teach you and then give you a tax strategist to put in your life, you'd be shocked. Top depreciation assets to invest in is gas and oil, which also is water reclamation now, and aviation. Those are your top. Right next to it would be your real estate because of all the bonus depreciation. After that would be RV parks, storage, heavy equipment rentals are huge benefit, and the depreciation schedules, water rights, mineral rights, the way you can cross-segment them using a C Corp again. There are so many strategies. You've got to let us help you, or just overpay tax. Last, I want to just tell you that $10,000 a year in overpaid taxes for 20 years puts 1.1 in the IRS's pocket. It could be in your balance sheet. So you make a decision whether you're going to make this important and stop just continuing to spend the way you spend. Let us reset the way you do that, the way you bank, the way you use your credit, the way you use your credit funding, all of it. So please download the book. It's in the show notes below. Read it all. There's chapters like Rick Noonan, who actually moved to a self-directed IRA, and all of the assets that he bought inside of the IRA grow tax-free, tax-deferred. You're going to see all sorts of creative strategies inside the book that you've never been able to see or know they exist. And if you ask a traditional company, they're going to say, no, we don't do that. That doesn't mean it can't get done. It just means they don't offer it. So when you go up to chapter 3 in the book, you want to do the gap analysis. And then when you're done, send it in, call our office, and let's talk it through. Where are the gaps in your life? Where are you? What do you want? And let us help you with our integrated team. And if you don't have an integrated team, try to put together a phone call with your CPA, your real estate agent, your estate lawyer, maybe a corporate specialist. I bet you can't get it done. And then the IRAs, I mean, unless you know the handful that do it, it's really rough to find them. So again, be on my channel, be here every day. We're here 5 days a week. When you have questions, you're going to askloral.com, AskLoral. Before we leave, make sure you get that tax and entity report. It's brand new and awesome. It talks about the big, beautiful bill. Talk to you tomorrow.